welcome you all to Value Talks. So I'm your host for the evening. I'm Captain Vipul Choudhary, one of the co-founders of Value Talk and alumni from MDI Gurgaon, having served with the Indian Army for around 6 years with Gorkha Rifles. And I've been into real estate investments and advisory for almost 15 years now. We have with us today Puneet. Before we start the talk, let me give a brief introduction about Puneet Khurana. I'll read it out. He is a chartered financial analyst, a CFA charter holder, and presently the chief investment officer and fund manager at Stoic Investment Managers. He's also an alumnus of the Management Development Institute, Gurgaon. Besides about Stoic Investment Managers is a decade-old investment advisory firm which is focused on providing equity advisory and asset allocation solutions to HNIs, retail, and family offices. Before Stoic, Puneet has led two equity research desks at two India-focused hedge funds with size of $1 billion assets under management. And the underlying philosophy that Puneet follows of value investing combined with evidence-focused research has helped him generate significant returns for his clients many years, consistently over many years by channelizing their wealth into discretionary and rule-based portfolios. Puneet is a regular speaker at various academic, government, and financial institutions and investment conferences, and is also an adjunct faculty at IIT Delhi and MDI Gurgaon. He delivers sessions on subject of behavioral finance, investments, and risk. Besides that, he also has taken classes in TRAI, that's the Telecom Regulatory Authority of India, CF institutions, and other financial institutions like Edelweiss, DSP BlackRock, Birla AMC, UTI AMC, etc., etc. And Puneet was highlighted by CNBC for their popular show Smart Money, CNBC TV 18 for their popular show Smart Money. He was profiled for that. With this background, I invite you today to Value Talks, Puneet, and shall we start the session?
Sure.
Right, wonderful. So just for recapping it for the audience, we will be today doing some basic discussions on what are the financial ratios by which, if we understand those first we'll try and understand what the financial ratios are, and basis that further we'll try and understand how they can be utilized to understand the investment capability or investment worthiness of a particular stock. So could you just give us a brief about the 7 basic financial portfolios which we usually hear about and which mostly the investment consultants like yourself or the investment advisors or investment officers, they study to make their investments?
Sure, Vipul. So, see, first of all, let's just understand what financial ratios exactly are for, right? The idea is that when we are studying businesses, we need to evaluate those businesses. And to evaluate businesses, you need certain quantitative measures where you can make some judgment. And that is where financial ratios come into picture. Now, generally, when I'm teaching or I'm talking to somebody on ratios, I generally say that, don't go by what ratios the books keeps on harping about. Think of the business first. The ratios will start making sense for themselves. And eventually, what happens is for majority of the businesses, you start developing your own financial ratios also, depending on what is more prominent in that particular business. So financial ratios should be a flexible thing. It is not something which is hard coded, this is the formula, this is the ratio, and I'll just calculate the ratio without understanding the essence of it. So that is first basic advice on financial ratios. Now, what are the most common financial ratios? Generally we talk about ROE, or we talk about EPS and price to earning ratios, or ROCE, or debt to equity, and so on and so forth. So there are so many ratios, but to make sense of ratios, the best way is to think about what those ratios are talking about, right? And to do that, you should start with a framework. Now, the framework of understanding companies is the same framework you can use to understand your own wealth. Okay, so imagine you start a year and you have, let's say, 10 lakh rupees. Okay, and in the starting of the year, you use that 10 lakh rupees and you actually invested into an FD. Okay, and that FD, imagine that gives you a 6% return. Okay, or just for the sake of ease of example, let's say 10% return. Okay, so at the end of the year, you started with 10 lakh rupees and you made 1 lakh rupees in form of interest, and you ended up with a net worth of 11 lakh rupees, right?
Okay.
Now, if I draw a parallel, companies do something very similar. Companies start with the capital, they invest that capital somewhere, like you invested into FD, they will invest into some other asset, or it could be FD also, by the way, but they invest into assets. And then they use those assets, just like you're using the FD to create the return, they're using those assets to create a final return. And in this case, you created 1 lakh rupees. They create something called profits. At the end of the year, they create the yearly profits. Okay. So if I give you the context of the ratio, there are so many ratios that can be calculated using this. So you got 1 lakh rupees on 10 lakh rupees of starting capital. That is nothing but ROE. The final money you made on the equity you had in the starting. Sometimes you can do average equity. Again, I'm not going to go into the technical definitions of the formulas, but if you take the starting equity, you take the money you have made this year, you divide, you get the ROE number. So similarly, in companies, when you take the profit number and you divide it by the starting capital of the year, starting equity capital of the year, that becomes ROE, right? So drawing parallels actually help. Now, so, I mean, all ratios basically are talking about something like this. So if you want a framework, the best framework is to think that there is a starting balance sheet. The balance sheet is nothing but in your case, it was the capital you had and where have you invested that capital. So your balance sheet would have 10 lakh rupees as your equity and 10 lakh rupees as FD, which is sources of capital and application of capital. That's your balance sheet. Similarly, companies have their balance sheet where they have what their 10 lakh rupees is coming from, whether it is equity or debt or combination. Where are they putting that money? That is the starting balance sheet. And whatever they make during the year, that comes under a profit and loss statement, which is the P&L account. And these two statements, a lot of small components, you can come up with different ratios, right? So ROE is coming from there, debt to equity is coming from there, and other ratios, which we'll discuss over a period of time in this session. All of those are basically telling you something about the business going from there.
So, but I would still like to understand it from the ratio perspective, so that the audience today, they also have an academic understanding of the top 6-7 ratios which are usually discussed. So first, I would say, if you can give us a brief of what is the meaning of ROE or return on equity, and how is it any different from
as
ROI?
As I just said, ROE is basically saying this much is the profit I have made on the starting equity capital I invested in the business. Now, unlike you, or maybe even in an individual case, for example, the same example, let's say you started with 10 lakh rupees. Imagine that the 10 lakh rupees, 6 lakh was your own capital and 4 lakh you borrowed from somebody. Okay. Even then, you are still putting 10 lakhs to use, right? So on your balance sheet, you would show 10 lakh rupees as your capital. But now 6 lakh is equity and 4 lakh is debt. Okay. Now, if you're putting that 10 lakh in a very similar way, in companies, the capital can be divided into equity capital or debt capital, and they have the total capital, which is the left side of the balance sheet, they call it. Okay. Now, when you invest that money, you took 10 lakh rupees, you invested into asset. Okay. Your was an FD. In company's case, they take that 10 lakh rupees.
Sorry to interrupt you here. Would you be okay if instead of asset, we call it invested into my business or invested into the ongoing business, so that
sure, you can call it that, right? So when the company is taking that 10 lakh rupees, it is buying something for the business, right? It is buying a machinery, which is called a fixed asset, or it is basically putting that money to buy some inventory and all that kind of stuff, but they're putting it into the business, right? And then that business is creating money for them when they are selling the product, and then they are reaching that final profit number. Okay, so the final profit that is made divided by total capital is your return on capital. But instead of total capital, if you just take your own money, which is 6 lakh rupees in this example, that becomes ROE. So that is the difference between ROE and ROC, where you take the capital base is different. In one case, you are taking only the equity capital. In this example, for example, 6 lakh rupees was your money, 4 lakh rupees was borrowed. In a very similar way, when companies take only equity capital as the denominator, that becomes ROE. When you take the total capital as the base, that becomes ROC. Right?
And what would be P by E ratio then? The price by earning ratio?
Okay, before you come to price to earning, now let's break this ROE for the financial ratios first of all, because price to earnings, etc., comes from a valuation perspective, that how does one who is buying the company is going to value it at. But before that, let's understand how do you break this down, right? So all the other ratios, where do they fit in? Now imagine that you took this 10 lakh rupees and you invested into obviously some machine or something like that, or you invested into a business, right? Now using that machine, you created something worth, let's say, 25 lakhs. All right. I mean, the market price of all the stock, all the stuff you're selling is, let's say, 25 lakhs. Now the 25 lakhs which you have sold is your top line. They call it the top line of your revenues number, which is there in the P&L, right? Now, after all the expenses, imagine that you ended up creating, created 25 lakhs, and at the end you just got, let's say, 2 lakh rupees final profit. All right. Now in this whole journey, there are multiple ratios which are contributing to that final ROE number, right? The first, let's break it down. ROE is nothing but PAT divided by equity investments, right?
Okay.
In a normal mathematical ratio of A by B is equals to A by C into C by B, I can break this ROE into 3 separate parts. Okay, that's usually called a DuPont analysis, but let's break it down. The first break is that you take profit and you divide it by sales, right? The second breakup is that you take sales and you divide it by the total assets where you have invested your money. And the third is where you take the total assets and you divide it by the equity capital. And these 3 tells you very different story. The first tell you, आपने वो 25 lakhs पे 2 lakhs बनाया, तो आपका margin कितना बनता है, right? What you call the margin of the business. It has nothing to do with how many assets you have. It is what was your revenue. Yeah.
I'll understand it from a businessman perspective. So अगर मैंने 10 लाख बनाया, sorry, let's say, for the sake of understanding it better, आपने 25 लाख का फिगर दिया था, let's say I made 2 lakh rupees. So मैं 8% के margin का धंधा कर रहा हूँ. My net margin after my PAT, if my PAT is 2 lakh on 25 lakhs of sale, then my net margin is around 8%.
Correct. Right. So okay. Even though you have made 2 lakhs on the equity capital of 6 lakhs, right, which is a 33% return you have made over your invested money, your business profit margins are just 8%.
Right.
Okay. So you need to break it down. Generally, different businesses have different kind of structures. So that is why I'm coming to that, right? So if you break down your 33%, you are saying 8% is my profit margin. The second number is what kind of revenue you did on what kind of assets you own. आपने धंधे में कितना पैसा लगाया और उस पे आपने कितना रेवेन्यू बनाया. ओके, आपने धंधे में तो 10 लाख रुपए लगाया था, 6 लाख आपका, 4 लाख डेट का, right? You took that, you invested that into the business, so that 10 lakh rupees was your assets, so to speak, and on that you created 25 lakhs. So on 10 lakhs you creating 25 lakhs. That is nothing but, that is the traditional name for this is called asset turnover. Okay, so which is on 1 rupee of asset, how much revenues are you creating? So if you now break it down, first part of your this business was 8% margin. The second part is 2.5% asset turnover, and then the third part, which is कि ये जो 10 lakh आपने invest किया था, इसमें से 6 was equity. So your total assets divided by equity, which is 10 by 6, that number becomes your third multiplier. Okay, so if you want to judge a business, you are judging it by just one number, which is the ROE number, which is return on equity number. That as a owner, मेरा इतना पैसा लगा और मैंने finally इतना पैसा बनाया, right? But अगर आपको किसी भी बिजनेस को थोड़ा और डिटेल में समझना है, you need to break it down, and the first level of breakdown is these three ratios. First being the profit margin, second being that asset turnover, and the third is nothing but the total capital divided by equity capital. You usually call it leverage, in the most common parlance. Okay, but
Correct.
again, conceptually it should be clear.
In this particular case, I'm just extrapolating what you said. If there is a 8% margin, and right now I might be making return on equity, but let's say if the industry faces a headwind or there's something untoward which happens, and 8% may be too thin a margin for me progress year on year. So this could be a business which may give a high ROE in a particular year, a return on equity, but this could be a business with otherwise might be an industry with poor fundamentals, or I don't know.
You're correct in the way that, see, majority of the time what happens is that industries have different kind of structure. So if you think of only this particular three items which I said, right? Imagine a business like a retail business, right? Like let's say a DMart kind of a business. They make wafer thin margins, okay, but they make it consistently. Wafer thin margins. So their margins are very low, but their ROEs are very high. Okay, so अगर आपको किसी भी बिजनेस में पैसा बनाना है तो आपके पास ये तीन लीवर्स हैं. पहला है प्रॉफिट मार्जिन का. आप एक लो मार्जिन बिजनेस भी कर सकते हो, उसके बावजूद आप बहुत प्रॉफिटेबल हो सकते हो बाय बीइंग अ वेरी हाई एसेट टर्न कंपनी. ओके, सो रिटेल बिजनेस डज दैट.
डीमार्ट का जो इन्वेंट्री मूवमेंट है वो काफी फास्ट हो रहा होगा, सो दे आर
करेक्ट. So a retail business is where margins are very low but your asset turns are very high. लेवरेज तो एक चॉइस है, आप डेट लेना चाहते हो कि नहीं लेना चाहते हो, उसको हम थोड़ा साइड में रखते हैं. बट फॉर अ बिजनेस दीज टू ऑप्शंस आर देयर. सम बिजनेसेस ऑपरेट इन एन एनवायरनमेंट वेयर दे हैव लो मार्जिन्स, बट दैट डजंट मेक इट अ बैड बिजनेस. Bad business or a good business is not determined. This is a common mistake I've seen. People say, "Arey yaar, this is a low margin business." It doesn't matter. If it's a low margin but a very high asset turnover business, you will still make great ROEs. And remember, for an owner, what matters is how much final money you're making on the equity capital you're putting in. Okay, so understanding the breakup helps you there. Now, remember the third part, and I will just touch it and then we'll not touch it again. The third part is the most riskiest way of increasing your return on equity, because ultimately you are saying कि यार मेरे को 10 लाख पे मेरा 2 बन रहा था, तो मेरा 20% ROE है. बट अगर मैंने इस 10 में से 6 लाख अपनी जेब से डाला है, 4 लाख लोन लिया है, तो मेरा ROE एक्सपैंड हो गया. क्यों? क्योंकि मैंने अपनी जेब से कम डाला और मेरा डेट कैपिटल था, राइट? सो बिकॉज बाय टेकिंग लेवरेज यू इंक्रीज योर ROEs. Okay, but leverage has the other features. I mean, let's not go there, but we know that leverage is a fixed cost capital which needs to be paid every year. So in bad years, it can punish you. So that is a different lever. That is the most riskiest lever people play with. And that is why discussing that is something which, I mean, everybody knows that taking debt and doing business is a risky proposition to do. So return on equity and return on capital from now on, from this moment, let's assume that whatever we are discussing is for a company which doesn't have any debt, and ROE and ROEC are same. Okay, so that our understanding is focused on the business and not on the capital structure, which is how much debt, how much equity.
Right. So can we move on to the next 2-3 things which generally are asked? What is the meaning of quick ratio? What do you understand by quick ratio?
See, generally what happens now, अभी मैंने आपको ये 2 ratios 3 ratios बताई, right? 3 breakup दिए ROE के. Now, if you look at the asset side of the balance sheet or the P&L, we talked about profit margin and we talk about asset turn, right? अब होता क्या है कि in a real company, it is slightly more complicated. Profit margin is the final number. You can break it down at multiple level. You can break it down at a gross level, जहाँ पे सिर्फ raw material cost को लेते हैं, direct cost को लेते हैं. You can break it down at EBITDA level, जहाँ पे हम सारी operational cost ले लेते हैं, and you can break it down at the final PAT level. Similarly, जब आप assets को देखते हैं, तो assets में भी you can break it down further. You can break it down at just 2 levels, which is fixed assets and working capital assets. And then within that, you can break it down even further, where you take working capital assets, make current assets and current liabilities. Okay. So current assets and current liabilities level पे जब हम जाते हैं, वहां पे ये ratios काम आती हैं, which is the quick ratio and so. But I'll tell you one thing: quick ratios and other ratios are mostly for people who are evaluating a company from a debt perspective and not from an equity perspective. It's a very big problem in our industry that people say higher current ratio is a good thing to do, but that's not necessarily true, right? Imagine, and I'll give you a very simple scenario. Okay? Imagine you are doing a businessman. I mean, you are a businessman, right? So what scenario would be preferable to you? Would you want that आप जब माल बेचें तो आपको पैसा immediately मिले या थोड़े टाइम के बाद मिले?
Immediate.
You want immediate paisa? That means you want your receivables to be as low as possible. Correct?
Yeah.
Now, whenever you create something, do you want कि वो immediately बिके या थोड़ा टाइम के बाद बिके?
Immediately.
Immediately बिके. That means preferably you would want as low inventory as possible. Okay.
Correct.
Now, when you are buying some raw material, would you want that उस बंदे को मेरे को जो पैसा देना है वो मेरे को immediately देना पड़े या मैं थोड़ा टाइम रुक के भी देख सकूं तो better होगा?
I would like to delay that.
You would like to delay that, right? So you would want payables to be as high as possible, right?
Correct.
So in a good business, if you can keep your current assets low, which is receivable low, inventory low, and your payables high, actually it's a good scenario, right? You want to be in a scenario where your working capital is actually negative.
Yeah,
But
because
people
I'm
say that,
getting
okay,
funded, my business is getting funded by sales. I am not.
correct. So your business is getting funded by working capital. Majority of the time people say कि working capital ratio बहुत जितना ज़्यादा है उतना अच्छा है. But ऐसा working capital ratio ज़्यादा है इसका मतलब आपके receivables, आपके inventory ये सब ज़्यादा है और आपका payables कम है. और बाकी I mean I'm just going by the most common assets and common liabilities. Of course I'm ignoring cash and other components, but I'm just trying to give you a perspective that many people think of these ratios, but these ratios are valid for those people who are betting or who are actually counting on the asset value, जो कि यूजुअली तब होता है जब एक लोन दिया जाता है. जब आप लोन देते हैं तो आप देखते हैं कि इस कंपनी के पास कितने फिजिकल एसेट हैं, इसके पास इन्वेंट्री कितनी पड़ी है, ताकि मैं इसको इन्वेंट्री के बिहाफ पे लोन दे दूं, राइट? तो जब बैंकर,
maybe this could be true for some of the companies which are actually dealing in inventories which themselves are assets, and if the asset price is rising.
so yes, I mean inventories are always assets, and but that's a risk. I mean that's a business cycle management. अभी उस पे नहीं जाते हैं. Some companies do take inventory, opportunistically. कि अगर prices बढ़ रहे हैं तो you keep the inventory with you and you can sell it later on at higher prices. But I'm just saying from a layman evaluation perspective, thinking that high working capital is a good thing is actually a wrong way of looking at it when you're looking at it as an owner. For an owner, you want working capital to be as low as possible, negative preferably. And majority of the best companies in our country, take the Nestle's of the world, Asian Paints of the world, all of them have negative working capital. None of them have, high receivables, high inventories. On the contrary, some of the poorer companies have high working capital ratios. So for a bank, it may make sense to give them a loan because, they can hypothecate the assets and they can give a loan, on the basis of those assets. But for an equity owner, that's not the most optimum state to be in. So from an equity vantage point, I would say not too much weightage should be given to the nuances of the quick ratios and the current asset ratio. But you should know the drivers. I mean, obviously somebody can show, the same scenario for a bad company actually will be very bad. If a company is not having receivables and not having inventory, but having a large payables, could also be because the company is not able to pay.
Understood.
Right?
That is probably where default is happening. They are not deliberately paying their vendors.
Correct. So that is why the context of the company is very important. और उसके लिए वो जो ऊपर का ब्रेकअप है, margins, asset turns, फिर asset turn को भी आप ब्रेक कर सकते हैं, margins को भी आप ब्रेक कर सकते हैं further, वो बहुत important हो जाता है.
What is this debt by equity ratio? How do you understand? Explain that.
So it's the same thing which we discussed. The third driver जो है ROE का, that is nothing but how much capital you are putting into the business. जैसे हमने अभी अपने example में लिया 10 लाख और denominator में लिया equity which is 6 लाख, right? तो अगर मैं 10 by 6 को देख रहा हूँ और the other way usually people do it is 4 का मेरा debt था तो 4 by 6, that becomes my debt to equity. So in my 10 lakh rupees capital structure, I finance that using 4 lakh of debt and 6 lakh of equity. That is a debt to equity ratio. Now, as I gave you an example, in this very example, I just told you that you can always increase your ROE. You can simply do, यार मैं 1 लाख अपना डालता हूँ और 9 लाख debt ले लेता हूँ. So your ROE will become 200% because you're making 2 lakh rupees, right? You're as an owner, you have doubled your money just by profits. Actually, you've tripled your money because 200% ROE. But because your debt is 9 lakhs, in a bad year, it will kill you.
Correct, because I will not be able to service my loan.
Yes, and for financial institutions, this is precisely the business. There are many, I mean, the banks, and banks and NBFCs and all these companies, they operate on very low equity, very high debt. So when they create a 20% ROE, a good chunk of that ROE is coming from the leverage component. They have very little in terms of margin, very little in terms of asset turns. Okay. Whereas look at the other side, let's say a Nestle kind of a company or a ITC kind of a company. Majority of their ROE is driven by these two numbers, asset turns and margins. They are not levered at all. They don't take any debt. Nestle, I think, it's debt free right now. So all these companies, debt is not there. So their debt to equity is zero. So it just tells you how the capital structure is. That is what debt to equity is. So all these will eventually point to this major breakdown, which is ROE, or ROE का जो breakdown है 3 number का. Almost every ratio, help you in giving this perspective.
Okay. Now, what would be a price by equity, P by E ratio, price by earning ratio?
So प्राइस बाय अर्निंग और इस टाइप की जो बाकी रेशियोज है, प्राइस टू बुक, प्राइस टू अर्निंग, ये सब जो रेशियोज हैं, ये बिजनेस इवैल्यूएशन रेशियोज नहीं है. अभी तक जो हम कर रहे थे, वी वर इवैल्यूएटिंग द बिजनेस. वी वर नॉट सेइंग कि मेरे को खरीदना है या बेचना है. वी आर नॉट टॉकिंग दैट लैंग्वेज. ऑल वी वर सेइंग इज लेट्स इवैल्यूएट दिस बिजनेस. इज इट अ गुड बिजनेस? सो फॉर गुड बिजनेस वी सेड ओके, आरओई अच्छा है तो इट मस्ट बी अ गुड बिजनेस. बट it's a good business only when ROE is also good and it is not being driven by high leverage, but the high margins or high asset turns. So ye business evaluation hua. Now, as equity investors, what we are doing is we are not just evaluating businesses. We are also buying those businesses, right? So today, if I'm buying a business, I'm going to pay some price for it. Okay. Now, when I'm paying a price, I need to evaluate, am I paying a good enough price, or I mean, how do I value this particular business? Okay, so all these price oriented ratios are basically a way to comment on those, right? So price to earning is simply saying, जैसे इसी एग्जांपल में देखते हैं, मेरा अर्निंग था 2 लाख रुपए का, right? Just for the sake of ease, let's imagine कि 1 लाख शेयर्स थे इस कंपनी के, so it becomes 2 rupees per share. Okay. Now, if I'm let's say paying 30 rupees per share to buy this share in the market, okay, that is basically I'm saying I'm giving 15 times the multiple to earnings. That is what the ratio means. Okay. Now, whether it is good, bad, I'll come to that. But let's first understand what it is pointing to. So it is pointing to that number. So what I'm saying is, अगर मुझे इस कंपनी को खरीदना है, तो मुझे, क्योंकि ये कंपनी 2 लाख रुपए बनाती है और मेरे को इस कंपनी के एक शेयर को अगर खरीदना है तो 2 रुपए पर शेयर बनाती है, तो मेरे को अगर 30 रुपए देना पड़ रहा है तो 15 का पी देना पड़ रहा है. सो इट्स अ डेरिवेटिव. पी इज अ डेरिवेटिव ऑफ कितना प्राइस आपको देना पड़ रहा है और कितनी उसकी अर्निंग्स है, राइट? कुछ लोग अर्निंग्स को ना देख के एसेट्स को देखते हैं. तो जैसे इसी एग्जांपल में 2 लाख रुपीज वाज माय प्रॉफिट और 2 रुपीज वाज माय अर्निंग पर शेयर. माय इक्विटी वाज 6 lakhs, which basically means on lakh rupees shares, I am having 6 rupees per share as the net worth of this company or the equity of this company, which is also called book value of the company. Okay. So now the same thing, I'm paying 30 rupees, 6 rupees is the book value. So I'm paying 5 times book. They call it 5 times price to book. Okay. So it's just a measurement. It's simply just saying कि इस company के लिए मैं कितना multiple अर्निंग्स पे देखूंगा तो पीई हो जाएगा, बुक पे देखूंगा तो पीबी हो जाएगा. एंड देयर मेनी अदर वेज. सम पीपल लुक एट सेल्स, प्राइस टू सेल्स, सम पीपल लुक एट एंटरप्राइज वैल्यू रेशियोज एंड सो ऑन एंड सो फोर्थ. बट ऑल ऑफ देम आर फ्रॉम अ बायर्स पर्सपेक्टिव.
I'll interrupt you here, and for the audience, just to make it simple for them to understand. और Puneet, correct me wherever I have understood it wrong. So इसी एग्जाम्पल को मैं बहुत ही ले भाषा में समझाने की कोशिश करता हूँ. मान लीजिए आपने एक 10 लाख रुपए का पैसा लगा करके व्यापार स्टार्ट किया. उस 10 लाख रुपए से आपने कुछ सामान खरीदा और 1 साल में बेच करके वापस खरीद के, बेच करके वापस खरीद के, टोटल सेल्स आपकी साल में 25 लाख की हुई. उस 25 लाख की सेल पे आपने 2 लाख रुपए का नफा कमाया. तो 2 लाख रुपए जब आपने प्रॉफिट कमाया, इस 10 लाख रुपए में से 6 लाख रुपए आपका था. तो जो आपके 6 लाख है उसके ऊपर 2 लाख की आपकी कमाई हुई, मतलब 33.5%। ये आपका हुआ रिटर्न ऑन इक्विटी। जो 2
Sure.
लाख रुपए आपने पूरे 10 लाख पर लगाए थे, वो आपका हुआ रिटर्न ऑन इन्वेस्टमेंट या रिटर्न ऑन कैपिटल एम्प्लॉयड,
Sure.
विच वॉज 20%। और जो तीसरी बात यहाँ पर पुनीत ने हमें बताई, प्राइस बाय अर्निंग। प्राइस बाय अर्निंग का मतलब ये हुआ, मान लीजिए अब इस कंपनी को खरीदने के लिए पुनीत ने ये कंपनी चलाई थी और ही सेज कि मैं इस कंपनी को आज सेल करना चाहता हूँ, और उसको सेल करने के लिए उन्होंने ये कहा कि आप आकर के इसको खरीद सकते हैं और मैं ये कंपनी आपको 1.5 करोड़ रुपए में बेचूंगा। तो 1.5 करोड़ रुपए में, या लेट्स से 1 करोड़ रुपए में बेचूंगा, या और सिंपल करते हैं 60 लाख रुपए में बेचूंगा। अगर वो 60 लाख में बेच रहे हैं, 6 लाख रुपए उनकी इक्विटी थी, 60 लाख में आपने खरीदा, तो आपने 1/10 का बुक, 10
10
टाइम्स
times.
बुक पर खरीदा। और क्योंकि उनकी 2 लाख रुपए की हर साल की अर्निंग है, वो अर्निंग आगे बढ़ती है घटती है वो एक अलग बात है, बट 2 लाख रुपए की अर्निंग है, तो आपने 2/60, दैट इज 1/30
So
के
30
पी
times
के ऊपर।
earning आपने दिया.
हाँ, तो 30 के प्राइस बाय अर्निंग रेशियो के ऊपर खरीदा।
Correct.
इज
You're right.
दैट सो फार करेक्ट
Yeah.
समरी ऑफ?
So, but I mean, for everybody's benefit, I'm just simplifying a lot of things. Obviously, ROC and ROE may there's a slight difference between the numerator also, but this is just to give you a perspective of the broader picture, right? Because there is an
Right.
interest component that comes into picture and so on and so forth, without complicating all those things.
Correct. Now, what would be the first ratio if I am to start evaluating a big universe of stocks available? Listed companies ही इतनी हैं, top 500 है क्या? What would be the first ratio you would say should be used for starting a filter कि ये मेरी top 10, 20, 30, 50, या how, with what ratio should I start prioritizing?
एक्चुअली अभी के जो कॉन्स्ट्रक्ट मैंने आपको दिया, आप खुद ही वो सोच के आप मुझे बताएंगे कि क्या रेशो होनी चाहिए, राइट? तो अगर मेरे को ये देखना है कि यार मेरे को एक बिजनेस सर्च करना है, what I'm looking for, I'm looking for the most profitable business, right? So technically I should be looking at ROE, because ROE is telling me the most profitable business. But then
Not
also I told you one thing, which is one part of the business can be coming from lever, which is the debt to equity wala portion.
correct.
So the most optimum way of looking is कि कितना profit बनता है कितनी total capital पे, equity और debt को breakup ना करके. The most, I mean, the common parlance for this is ROIC or ROCE, and there is minute differences in all of these. Okay, but for a basic understanding, you should take ROCE or RO, return on capital, as your major starting filtration ratio. Why? Because that tells you कि इस धंधे में कितना पैसा बनता है. अगर इस धंधे में 10 लाख रुपए लगे हैं तो इसमें 2 लाख रुपए बनता है, वो आपको बताता है ये वाला रेशियो. अगर आप ROE लेंगे तो उसमें एक प्रॉब्लम ये हो सकता है कि कोई बिजनेस अगर बहुत लीवर्ड है तो फिर वो वाला बिजनेस भी आ जाएगा, जबकि आप वो एक आइडियल सिनेरियो नहीं है. तो या तो आप दो रेशियो कंबाइन कर सकते हैं, विच इज यू कैन कंबाइन ROE for those companies where debt to equity is very low, so you are doing the same thing, or you can do return on capital. These are primary ways where you do the first filtration, at least from the quality of the business perspective. Of course, you know, value is not driven only by that number. There are other factors you need to consider. But if you're saying here, if nothing else is there, only one ratio you have to take, okay, and quality of business is the criteria of evaluation, then I would say return on capital is the way you should start from
Return
the
on
quality.
capital employed.
Yes, yes. So you take the total size of the balance sheet and you took the profit number, you know, from the P&L statement.
I'll have one last question for today before we open the session to questions from the audience. Are there some ratios which are only for academic interest or which can be later on maybe, चलो, you know, इसको भी देख लेते हैं types. Last filter before taking a decision.
No. So see, as I told you, right, हम लोग ना कभी भी ऐसा नहीं करना चाहिए कि यार ये सेट ऑफ 20 कंपनीज, ये सेट ऑफ 20 रेशियोज हैं, ये देखनी है. आपको ये देखना है कि मेरे को इस बिजनेस को जज करना है और उसके लिए जो रेशियो मेरे को चाहिए वो अवेलेबल होनी चाहिए. फॉर मेनी कंपनीज सम रेशियोज विल बी एब्सोल्युटली यूजलेस, but the same ratio will become very beneficial for other companies, right? So you never have, so you can never say that okay, this ratio is useless or this ratio is not useless. What I find academic sometimes is the number which people try to put. So many times, as I told you, right, अगर आप कोई भी बुक उठाएंगे तो आप उसमें देखेंगे कि एक आइडियल रेशियो दी जाती है. Some people say ideal debt to equity ratio is, let's say, X. Could be 0.5, could be 1, whatever. Some people say ideal current ratio is 2. 2:1. ये बहुत कॉमनली हम बुक्स में देखते हैं. तो जो नंबर्स दिए जाते हैं ना, ये मेरे को बहुत अकेडमिक लगता है, बिकॉज हर बिजनेस अलग तरीके का होता है. A very stable business can have some leverage and it will not kill it, right? And the best example here is, look at the banks, right? Banks has the highest leverage in the world, but I mean, we have institutions like HDFC which are running for 25 years profitably without any problems, right? So but यही leverage अगर मैं एक infra company में डाल दूंगा तो वो 4 साल में खत्म हो जाएगी. I mean, one bad year, because it is cyclical in nature, one bad year and the complete net worth can get wiped off, right? So एक absolute number देना is an academic exercise. You need to have the understanding of the industry and businesses to come up with what is the threshold for those ratios. Ratios अपने आप में academic नहीं होती. On the contrary, we tend to create many new ratios based on the business. So sometimes we know that, okay, this ratio might not be important. Just to give you an example, let's say in many cases, we will remove certain components from loans and advances to calculate our return on investment number or return on capital number, because that part of the money is not invested in the business. So we create those ratios because that is the right ratio for this particular business. I mean, just to give you a context of how ratio should be thought over.
Since you use the word context, so let me reiterate what you just said. What you're essentially saying is that ratios are important. Where it becomes academic is जब उसको oversimplify करके कह देते हैं कि भैया debt by equity है, one is a good this thing, current ratio to, without setting it in the context of the industry or the business.
Absolutely correct.
So all
Absolutely
ratios
correct.
have to be seen in the industrial, the business.
Absolutely correct. And as I gave you an example, right? Many people, this whole thing comes from academics where people say, low margin business hai. Bad businesses usually have low margins. That's not true, right? We know that high asset turn businesses like retail can be excellent business. I mean, think of the wealth Walmart has created for its shareholders despite being a retailer, which is essentially a low margin player, right? And in India, DMart has created, and many other retails eventually can have at least have the potential to create a significant amount of wealth. So yeah, so everything is contextual. You cannot have hard fast rule for anything in equities.
Right. Awesome. Thank you so much, Puneet. It's been a very, very interesting and informative session. I will open the house now to questions from the audience. But before I do that, I'll request all those of you who intend to interact with Puneet or any of our other panelists and experts who keep joining us on Value Talks. I have posted the link for Value Talks Telegram group on the chat box of today's meet. You can just link on it, and Telegram is a free app available on your Android and Apple phones. You can join the Telegram group there and have any kind of a follow-up query or questions you have from our experts. And to view our talks, earlier talks, we have 2 talks from Puneet also there, and we keep on putting other talks there. You can also subscribe to our YouTube channel. I don't need to introduce YouTube to you. It's available to everyone. The link to the YouTube channel has also been posted. You may please use these links to subscribe to the Telegram group and subscribe to the YouTube channel.
Gotta focus on this.